Well, we've seen today, right, with the news on new tariffs, we don't know where we're going to end here. I think the question is not so much how much the U.S. will do, is how much China and potentially Mexico and Europe will retaliate in case, because this is where I think we really don't know, and the impact could be very significant. My feeling is that, again, is priced in what is priced in. The regulation, tax cuts, market an all-time high, but there is this, obviously, the risk on the tariffs on one side, but also bond is going through the roof, and this will completely change, obviously, the narrative and also the valuation for equities. It's a very, very significant risk in our view.
You say an all-out trade war, but what does that really mean? Because when it comes to Mexico, some of the instant reactions being they're looking at BYD and whether it'll break ground in Mexico, and now authorities are saying, well, maybe that's not a great idea because it could irritate the Trump administration. That doesn't look like a country response of an all-out trade war. That's almost kowtowing to what is an American policy.
Well, first of all, the market seems to expect this trade war to be effectively just a long negotiation process where the U.S. gets something and China, Europe, Mexico probably have to give something. The market doesn't expect no trade war. The point that we're making here is that there is a possibility that Trump will implement significant tariffs. There will be a lot of pressure in China, Europe to do exactly the same, and we know how this will end. So I think that is a risk that is underpriced. It's not our best case scenario, but as always in our business, we have to price in also the tail risk, not only the best case scenario.
But Luca, there are two constituencies that love what they're hearing. One is the American people, because they voted for the President-elect Trump as well, and two, the stock market. The stock market has rallied aggressively to record levels at a time of large impositions of tariffs, not promised, but actual. Again, I'll say to you, go to this White House page as well, which has got, I think we've got some elements on it as well, haven't we? The current state of U.S. tariffs on China. There are vast amounts of tariffs on Chinese goods. That's not always going to be a negotiation. This is the real here and now. And the stock market is rallying aggressively to record levels. Market likes it.
Well, market likes it. Well, I would say the market doesn't believe we are going in a situation of massive retaliation from China and Europe. The reason why the market is still relatively okay is because they don't expect China to really anything about it. Because China can still hit the US as well. They're just very weak. They're probably forced to follow the US, and that's why the market continues to go higher. I don't think that the market is totally unaware of the risk. It just is they're mispricing the risk of an old trade war.
But the market, but you say this again. I don't know. So I'm just asking the question. I don't really think I'm taking one view or other, but I am challenging you. And these tariffs you can see on the screen, could see on the screen. Thanks, Will. We'll get back. These are clear and present. The market and US corporates are negotiating that really well. The US consumer has seen inflation come down aggressively, albeit not to the levels it would like to see, with these in place as well. So the equity market knows that these tariffs are here and the earnings are still going through the roof. And the consumer knows these tariffs are here and was happy to vote for Trump and more of the same. So are we being way too pessimistic?
No, first of all, we're not too pessimistic. We think that the market's too optimistic. I think it's probably better to put it that way.
What do you do? What does that mean then? So you're saying be careful, but actually market's going up. Is that what you're saying?
We are still overweight equities. We just don't feel there is much upside from here because we have markets at an all-time high. We have the Fed probably is not going to cut that much. And I think if you look also the U.S. consumer is doing very well. But you can see at the margin, you see the delinquency rate going higher, you see employment growth being a little bit weaker. We're still bullish, but I think it's better to trim some exposure given the massive rally that we've seen recently.
Can I pick up on one of your warnings? Beware of boom-bust cycle impacting markets. For a long time, we've been managing the downside. Let's just avoid a recession at any cost. I mean, that's been the response from authorities, that we really don't want to go into deep recessions, let alone a recession at all. But we've also juiced the upside. We've had markets, economies expanding. We're throwing more stimulus at it. So are you saying there's now a danger of the bad old days of that real swing and boom-bust?
No, I think when we look at what Trump is planning to do, deregulation, tax cuts, that normally what create a melt-up scenario that tend to end badly. But we still have time. I think it's too early. I think our view is that you still have to be invested in equities. But at the same time, the upside that we have last year We don't have it. So I think there is much limited upside from here.